Hello, it's Ed Denny. It's actually Sunday evening, September 28th. I'm off to a week in California to visit with accounts. This is part of my Roaring 2020s tour. Taylor Swift did her New Era tour, or Eras tour, I should say. And I guess I'm kind of trying to copy that. I'm not getting the kind of turnouts that Taylor Swift got, but I'm very happy to meet with accounts and just did that in Austin and Houston, and now I'm off to California, and I'll be visiting other parts of the country before the end of the year into early next year. Anyways, here in New York, the weather's been phenomenal. Actually, it looks like we're starting to develop drought conditions because it's been like a month now with very nice weather. It's actually been hot, kind of like summertime, so it's a little bit unusual to say the least, but we'll take it. Maybe we'll have a warm winter, which we wouldn't mind either. But look, lots to talk about here. I don't think any of us are minding or concerned that the market keeps going up. I mean, I don't think we mind seeing what the impact is on our portfolios, but there is actually a lot of concern about valuation. There's a lot of concern about the AI theme. AI has been a big mover of the stock market. And investors got a little bit of a shake up in January this year when DeepSeek, China's AI company, came out with a large language model that apparently had been trained on less powerful chips than NVIDIA's top 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 chips. But at any rate, the concern is that uh, there's gonna we're going to be creating more and more demand for this kind of technology. AI clearly is still a work in progress. There's a lot of unknowns about it. A lot of people are investigating it, trying to figure out how it's going to impact their business. If it's a big hit and it creates a lot of demand, that demand will feed on itself because the more data we can process, the more cheaply we can do it, the faster we can do it, the more data we're going to process, and so on. So there's sort of an infinity and beyond aspect to AI potentially. And if that's the case, then these so-called hyperscalers that provide the cloud are going to have to continue to spend ongoing large amounts of money to increase the capacity for what they have, which means that that kind of raises the question of whether they're ever going to be making a significant profit on this kind of investment if they never get to kind of stop the capital spending and just see the profits come in. Another possibility is that these companies already are committing too much money to AI capacity and that there will be a slowdown in the demand. Anybody who's investigating AI and concluding that it is useful will use it, and that'll be kind of be the impact in a positive way on the demand. And then lots of other people may conclude that it's not worth the effort. A lot of people are finding that they have to double check what AI is spewing out, and sometimes spending that effort is equivalent to actually doing the work yourself. So we'll see. I still think that artificial intelligence is useful. Useful. I think there's a certain amount of hype. I'm still think that artificial intelligence is artificial, or AI is artificial. I don't think it's intelligent. It doesn't really recognize what words are. It's autofill on speed and steroids. Um, but, it is a useful research tool. I use it every day as a research assistant. In the past, I'd go to Google and I'd find the articles that were relevant to what I'm writing about, and then I'd read the articles and I'd write. Now I can do the same thing with Grok or ChatGPT and basically ask these programs for the question that I'm like to write about, and they'll give me a summary of the relevant information with the sources. So it's again, it's kind of like Google, but it provides a summary of the information that the articles body. Uh, I do find that it makes mistakes, and so I do have to check it very, very carefully. And sometimes I do wonder, especially when I try to use it for lengthy research, I do kind of wonder whether it's worth the effort, whether I should just start from scratch on my own, do my own reading, come to my own conclusions. At least then I can trust the conclusions. But that's kind of where we are. A lot of uncertainty about the profitability of AI, the power of AI. I know that the head of Walmart came out and said that it's going to affect every job on Earth. Well, again, I think there's a lot of hype going on in this area, and we'll see. AI to me is just a evolution of the digital revolution. It's just an indication that we're now able to process even more data more quickly, more cheaply, and that's been the name of the game ever since the digital revolution started in 1965 with the IBM mainframe. Now, I did just spend several days in Texas. Had an interesting experience, particularly in Austin, Texas. Um, I miss the old Austin, Texas was a sleepy little town, state capital. Uh, it had lots of good music, and it was very quaint. The airport was a 5-minute drive from downtown. You could see all the accounts pretty efficiently that way. Now there's skyscrapers all over the place and a lot of traffic, and it's just not the old Austin that it used to be. The airport, the new airport is already too small, and it's about 20 minutes away from downtown, but it's still a great town. And now, back in the old days, before Uber, I used to have a limousine that cost several $100s to take me around to see accounts. It was very inefficient. The driver kind of sat there in between meetings, and that's the way it was. Now I am using Uber to get between accounts, and I find that not only do I learn a lot from visiting our accounts and sitting and having conversations, I also find that conversing with the Uber drivers provides some additional kind of insights into what's going on in the world, what's going on in the economy, what's going on for people with different different lives than maybe we're used to crossing in our regular social circles. At any rate, it was somewhat hard to communicate with some of the Uber drivers in Austin, Texas, because they only spoke Spanish. And when they looked at when they listened to their Waze directions, it was in Spanish. So there wasn't much we had in terms of conversations. I guess I could have pulled out my and turned it on to the microphone and started to have a translation from that back and forth with the driver. But these trips between accounts weren't all that or long, so that just didn't make much sense. Then, for the first time, I had the opportunity to take a Waymo, and I took it. Um, and it was a little freaky because I'm used to using Waze for getting directions. So I put Waze on I opened up my Waze on my cell phone, and I kept screaming at the driver. And of course, there was no driver at the steering wheel. You're going the wrong way. You're going the wrong way. Because, the Waze would say make a right. And this thing just kind of kept going straight. And I kept looking at it. I guess it's got some other uh, direction program that it uses. But anyways, it got me to where I wanted to get. But it was a little strange being in a car where you couldn't talk to a driver. But then there were a few Uber drivers that I was able to talk to. One of them was Bonnie, and my morning briefing for Monday mornings is called Meet Bonnie. And Bonnie was a young lady who had 6 years of experience in the IT industry in Silicon Valley in California. She moved to Austin. At first, when she told me she moved from California to Austin, I said, "Oh, the politics got to you?" Said, "No, no, no, it's not the politics, it's the jobs." She said she's been laid off twice in Silicon Valley with 6 years experience. She was making six figures, and now she's driving an Uber in Austin. She thought there might be some tech opportunities in Austin, which is a booming area where a lot of tech companies are moving. I think Oracle is headquartered there. And Bonnie told me that she was very frustrated. When I told her, she asked me what I do. I told her I'm an economist. And she right away opened up and kind of like said, "Well, please tell me what's going on with the economy. When am I going to get a job? When are my friends are going to get a job?" She told me the only opportunity she gets are interviews for entry-level jobs, which to her is, it's too much of a drop in income, even though she's not making much driving the Uber, but that's temporary work if she wants to get a job where she was making good money in IT. She said that she has friends who have very little experience in the IT business that are also looking for jobs in IT, and she said they can't even get interviews. So it was a kind of a real insight into some of the labor market indicators we look at. We look at numbers and sometimes forget that there are people with experiences, um, good and bad, that are reflected by the numbers. But at any rate, it just kind of confirms my view that the labor market is very complex, a lot of moving parts. We've got the labor force falling because of the effective end of the illegal immigration from the southern border, deportations are taking workers away. We've got people like Bonnie who, well, she told me she blames AI for her misfortune. So we've got people who are losing jobs directly to AI in technology. I don't know happening broadly in other areas. I'm sure we got a lot of companies that are spending money on investigating whether AI can be useful in running their operations. And until they come to their conclusion, then maybe they put on a hiring freeze. That doesn't mean they're not hiring. It means, if some people leave their company or they fire some people, they replace them, but they're not net adding to payrolls while they figure out what to do with AI. But it was very kind of ironic that I met Bonnie and had this 10-minute conversation, everything in 10 minutes, in the Uber car on Thursday of last week, because that morning we got a revision for real GDP, and real GDP growth for the second quarter was revised up dramatically from 3.3% to 3.8%. Leading the way up was consumer spending, which increased from 1.6% to 2.5%. And then on Friday of last week, the Atlanta Fed came out with its estimates for third quarter real GDP, and it's tracking at 3.3%, with a very solid and even stronger increase in, I think it was like a 3.4% increase in consumer spending, real consumer spending. Don't quote me. Take a look at the morning briefing just to make sure I got the numbers right. But I'm in the ballpark. The bottom line is GDP is strong. So let me ask you here, why did the Fed lower interest rates? Would they have lowered interest rates if they knew how strong the GDP is? Obviously, they responded to the weaker than they had expected and the downward revisions in payroll employment. But then we have this strong GDP numbers. What is lower interest rates going to do? Is it going to help Bonnie? I kind of doubt that. Is it going to perk up the supply of labor? I kind of doubt that. So if you factor in that what's going on here is we're revising real GDP up and payroll employment down, that means productivity is to be revised higher, which is fully consistent with our roaring 2020s scenario for the decade, and so far so good. But if we start to have some really powerful productivity numbers, that would be even better in terms of confirming everything we've been saying about the roaring 2020s and how better growth and productivity attributable to technological innovations would give us more economic growth, lower inflation, more real purchasing power, and higher profit margins. And you can almost check every one of those boxes. That seems to be what we're seeing right now. So you can get really depressed and look at the payroll numbers, which again, I think reflect a bunch of different factors that the Fed really can't fix lowering interest rates. Lowering interest rates might stimulate more demand, but if we're having a shortage of workers on a short-run basis, that risks boosting inflation, doesn't it? I think so, but maybe not if the roaring 2020s kicks in. But lower interest rates increases the chances of financial instability. I'd like to have a nice leisurely bull market up to 10,000 by the end of the decade, and I don't really want to get into a whole bunch of melt up, melt down scenarios. And the Fed's kind of taking a risk of stimulating just that. As a matter of fact, Jerome Powell had his irrational exuberance moment last week when he said that the stock market is highly valued, but he didn't think that was a problem right now. So that's where we are. It's still a bull market in stocks. We may see some correcting or consolidation in the AI theme. Maybe the Magnificent Seven take a rest here for a while, but there's also the impressive 493. And look, the Magnificent Seven, the cloud providers, they're not going to have sustainable earnings growth unless they have customers, and they can't just keep kind of doing business with themselves. I mean that we've seen Nvidia send $100 billion or claim they're going to spend $100 billion with OpenAI, and then OpenAI turns around and buys the chips from Nvidia. That's very reminiscent of what happened in the late 1990s, where telecom companies basically did seller financing and had remarkable orders and revenues and earnings because they were lending money to their customers. So when their customers really afford what they were buying, the whole thing kind of imploded. So I don't think we're in that situation. In the current situation, I still like information technology, but I of the four sectors we've been recommending, information tech, communication services, financials, and industrials, we really like financials. We think they have further to go. The earnings season is about to start. The Q3 earnings season is about to start. We will get bank earnings, and to start the season, and they seem to have everything going in their favor. There's a lot of M&A activity, IPO activity. The yield curve is steepening, and then the bank loans are increasing. The year-over-year percent change in bank loans is up 5%. So it's all looking like a good start for the Q3 earnings reporting season. Let's have a quick look at some of the charts, and then we won't have a Q&A because this is being pre-recorded on Sunday. So here we go. Real GDP, what do you need to know? 3.8%, very strong capital spending numbers. Fixed investment is very strong. Some of the PCE related spending, the personal consumption expenditures, very strong. So the second quarter, which some people attributed to just a reversal of the weakness in the first quarter related to imports and exports. Well, that's not the whole story now, is it? There really is strength there. And then not only that, but the third quarter is building on that strength because you can see that the GDP now forecast is actually 3.9%. And again, capital spending is quite strong. Consumer spending is also very strong at 3.4%. So that's all good stuff. So again, real GDP is increasing at over 3%. And meanwhile, the labor force or the hours worked is more like 1%. That's 2% productivity. If the labor force growth is more like 0.5, that's 2.5% productivity. And that's the way it works. We're thinking that productivity, which had been growing around 2%, is about to get up to 3% and maybe higher. Meanwhile, recession forecasts have dropped dramatically since the beginning of the year. We've had the most widely anticipated recession of all times that didn't happen over the past 3 years. And more recently, following this latest recession scare, in this environment, we haven't seen recession concerns, but we have seen concerns that the economy's growth will slow. And of course, the GDP number just completely blow that out of the water. We'll see how non-farm payrolls go. The optimists here, we're looking for 75,000. That wasn't very optimistic before, but now I think people are talking about break-even payroll employment for keeping the unemployment rate down around 4% is like somewhere between 35,000 and 75,000. We're going to take 75,000. Initial claims, that was really good data last week. Initial claims came right back down. That's layoffs, an indication of layoffs. So layoffs are very low, and another indication that the unemployment rate's probably staying low, around maybe 4.3%. Employment by selected industries. I just wanted to show you that Bonnie maybe is in here. This is employment and information is down 18,000. It's down by like about 1 million from this peak here in 2000 down to where we are now. So, the good old days when there were lots of jobs to be had there, that's just not happening. And that's partly because technology eats its young, literally, I guess. In Bonnie's case, it's found ways to reduce the demand for new entrants and even for entrants with several years of skills. And then when they let those people go, they come back and interview for the entry level jobs. It's not a pretty picture. Meanwhile, the Fed lowered rates back here in 2024, and of course, bond yields went up, mortgage rates went up. The Fed lowered here. The GDP data confirms our view that that wasn't necessary and risks financial stability, melt-up, melt-down scenarios. And indeed, bond yields seem to be ticking up here. Consumer spending, real strong, even though disposable income was on the weak side. How could that possibly be? Here's disposable income real. And the answer is the baby boomers. They're spending money. I saw that Mark Zandi of Moody's put together a study that made a lot of headlines that 10% of consumers account for 50% of consumption. Something just doesn't feel right about those numbers. We'll try to do some work on it ourselves, but we suspect that's a gross exaggeration. And certainly it's ammo for progressives to redistribute income and wealth. But we've been arguing for a while that a lot of the income inequality, wealth inequality in our economy has to do with demographics. Spock in Star Trek told us baby boomers live long and prosper, and that's what we're doing. We're living long and we're prospering, and so that's where we are. So you're seeing a tremendous a wave of retirement of the most well-off retiring generation ever, and they're spending their nest eggs. Again, they have over 51% of net worth. When we pass away, our younger children will get older and they'll get some of the inheritance, and they will prosper. Again, as Spock said in Star Trek, live long and prosper. Baby boomers own a lot of stock, so even as they're spending money on cruises and whatever, their net worth just keeps going up. They own 53.5% of this would be equities and mutual fund shares. So meanwhile, inflation is hovering closer to 3% than to 2%. The durable goods inflation does demonstrate the tariffs have indeed had an impact on inflation. Um, the non-durable goods inflation is tame, and rent inflation is coming down, but the super core inflation is sticky at over 3%. So the market is kind of coming back to our view that a series of rates is necessary. We didn't think that last year's rates cuts were necessary, nor this one's 25 basis points. We did argue last year that bond yields might go, which is what they did. We are arguing again that bond yields should be somewhere between 4.25% and 4.75% in that environment. So that's it. Gold continues to work nicely for those of us who've been bullish on it, and we kind of stay with it. So again, I had to record this on Sunday, September 28th. I hope you found that informative. I'll be back. I think I'll be back next week, and then we can have a Q&A and catch up with what's on your mind. Have a good week. All the best.